Hi everyone, welcome to Week 1 practice exercises. In this video, we're going to cover some of the concepts and principles from Chapter 14. If you haven't done so already, please open your spreadsheet as well as the financial ratios one-pager that is in your Canvas shell. If you haven't downloaded that yet, go ahead and navigate to the Week 1 Chapter 14 financial statement analysis and scroll all the way to the bottom. You'll see a hyperlink for a one-page cheat sheet. Go ahead and download that right now. As I mentioned in the welcome letter, management accounting really wants to focus on understanding how to interpret the data and the analysis versus memorizing those formulas. So the first analysis that we're going to perform is a vertical analysis. The second analysis will be a horizontal analysis. And then our third problem set will look at various financial analyses to include working capital, accounts receivable turnover, and asset turnover. So I'm going to drag the financial ratios one-pager off to the side. And I'm going to expand our Excel so that we can focus on it. So with the first one, our job is to perform a vertical analysis of an income statement using the following information. So you can see right now that it's really not in the right format of an income statement. So our first step is to arrange the information in the format of an income statement. So we're going to start here. Sales always starts your income statement. And then our cost of goods sold comes next. And then we have a calculation. And that calculation is gross profit. Next will be our selling expenses, our administrative expenses, and then we have another calculation. And that calculation is to total our operating expenses. The calculation after that is operating income, and operating income is just the difference between our gross profit and our total operating expenses. Then comes our income tax expense, and the very bottom line, which is our net income or our net loss. So now we have everything set up in the format of an income statement. Now we need to calculate the missing elements of the income statement. Again, I have gone ahead and laid in the information that was provided to us above, but I am going to walk back through it really quickly. I had a choice here. I could have either typed in 6 million, or I could make it just a little bit easier and I can just type in equals to signify that I want the spreadsheet to do something for me. And I'm going to come up here to the 6 million. I'm just going to click on it. And you can see that in that cell it says equals C22. I'm going to hit the enter button, and you can see that it pulls that information down into this particular cell. I could do the same thing with cost of goods sold, but you notice that my cost of goods sold in my income statement is signified as a negative number, and up here it's not. So I can do the same thing. I can say equals, and I want to make it a negative, and I just grab that cell and press the enter button, and we now see that my 3.4 million in cost of goods sold listed up here is now listed below. Okay, now let's go ahead and begin our calculations. I could either calculate this on a calculator and then enter the information manually, or I could get Excel to do the work for me. And so I started my formula with an equals, which tells, again, Excel that I want it to do some work for me. And I'm just gonna go up here and grab sales, and I'm going to add it with a plus sign to my cost of goods sold. I'm going to press the enter button, and you can double check the math, but our gross profit is now $2.6 million. I'm going to come down to my total operating expenses, and again, all I want to do is sum up my selling expenses and my administrative expenses. I could do the same thing I did up there, which was to say equals, grab the 1.1 million, add it to the 600,000, and I'm good. Or I'm going to delete that. There's another way that you can sum up things, especially if you have a long line of information that you want to sum. And that's just to start with the equal sign, type in sum, open parentheses, and then block off the information you want to sum. I'm going to close my parentheses, and that still gives me my $1.7 million. Now I want to calculate my operating income, which again is just the difference between the gross profit and the total operating expenses. So you know where I'm going with this. I'm just going to say, I'm going to type in equals, I'm going to grab my 2.6 million, I'm going to add it to my negative 1.7 million and press the enter button. And it gives me 900,000. I'm going to do the same thing with my net income, but this time I'm going to use that sum function and just block off those two. Okay, so we've completed the current year missing calculations, but we also have a previous year. Now we can either go through and do the same thing that we did for current year, which is equals sum, and then block this off, or I could make my life even easier, and I could come over here to my current year, and I'm going to click copy. I'm going to copy it, and I'm not copying the result. I'm copying the formula. And I know this is super tiny up here at the top, but I'm copying the formula. I'm going to paste it over here in the previous amount. And when I open it up, you can see that I copied the formula that said, pick this cell over this cell. I'm going to do the same thing with my total operating expenses and with my income. So I'm actually going to block those two at the same time. I'm going to copy that information. I'm going to come over here and I'm going to paste it. And you can see that I was actually able to copy two cells at one time. And of course, I could do the same thing here, but what I want to show you is that you don't want to reference this cell. When I reference a cell and I say equals 41, I'm not copying the formula, I'm copying the result. And so you can see here that it's 630 that pops up. If I were to copy the formula and paste it over here, then our result is a little bit different. All right, so that was a really quick rundown of how to get Excel to do your math work for you. Now we want to focus on evaluating the results. And that's where we're going to go into performing the vertical analysis. With a vertical analysis, we base everything on sales. So if I'm going to perform my vertical analysis, I can start here and I can say equals my sales divided by my sales again. And you see that I clicked that twice. I'm going to press the enter button. And of course, sales divided by sales is always going to be 100%, right? My cost of goods sold, I'm going to equals to open up the formula. I'm going to click on the cost of goods sold and I'm going to divide it. And that division is the slash, right? I'm going to divide it by sales. And we can see here that's 57%. So cost of goods sold is 57% of all of your sales. Gross profit should actually be the opposite of 57. And we're going to divide it by 6 million. And you can see that 43% and 57% are complementary, right? If you add the two of them together and you ignore that negative, that actually equals 100%, which makes sense. Sales minus cost of goods sold is profit, or I'm sorry, gross profit. Gross profit plus cost of goods sold should equal your sales. All right, we're going to do the same thing for all of these. I'm going to divide that by sales. And right now I'm really not paying too much attention and trying to evaluate each one because I want to look at this in a wholesome way. I'm going to divide it again by sales. And you can see that this does take a little bit of time. I'm going to show you a quicker way to do this when we work out the previous year amounts. All right. And then once we have our current year and our previous year we can begin to evaluate what this vertical analysis is telling us, right? Okay, I said I was going to show you a faster way to do this, and I can. I'm going to, again, divide sales by sales. But I'm going to stop right here. I'm not going to hit the enter button. I'm actually going to come over here to the second, to the side. Actually, let me not do it to this one. Let's do it to a different one so that you can see the two cells. So we're going to take our cost of goods sold and we're going to divide it by our sales. Now I'm going to pause. We can make this calculation go a little bit faster if we could just make sure that Excel knew that I wanted it to compare everything to the 4.7, right? So there is a way to tell Excel to hold on to a particular element of your formula. So I'm going to click inside of this. And again, I know it's kind of small, but I'm on the right side of the division sign and it's right before my E. And I'm going to type in a dollar sign. And then I'm going to put another dollar sign on the other side. That tells Excel that I want to compare everything to the 4.7. I'm going to press the enter button and you see that that amount is 54%. Now I've come back up to the 54%. I can do one of two things. I can copy this and I can paste it. And it gave me all of my information. Something else that I can do, when my cell is here, you'll see that your cell has a little block on the lower right. You can also grab that block and just drag it down. And the same thing happens. So the important part is not just performing the analysis, but it's what are the conclusions you can draw from this analysis. So the conclusions that I can draw very quickly are that my cost of goods sold is actually a little higher this year than it was last year. Now, there could be many things that cause that to happen. It could be that I'm using better quality materials. It could be that the economy is struggling a bit and the materials that I'm buying have just increased in price. It could be a myriad of things. So you really have to look at your economic indicators to determine if this is a good thing. We've seen with COVID-19 that our logistics, our supply chains were impacted, which actually increased the price of a lot of things. So this increase of 3% in the framework or in the mindset of, looking at it from a COVID-19 logistics and supply chain impact perspective, if we look at it that way, 3% might not be that bad. However, if we're actually in an economy where each year we're becoming more profitable and materials are cheaper, then this 3% would be of concern. So that's what management accountants look at. They look at the economy, they look at the environment that they're working in, and they're able to review these analyses to determine, is this a good thing? Is this a bad thing? Is this something I should be concerned with? Or is it a best practice that I really need to implement across the entire corporation? Okay, so that was our vertical analysis. We're going to use this same information right here, and we're going to perform a horizontal analysis. Now, I'm going to just close some of these rows so that we can still see the information as we perform our horizontal analysis. Okay, so same thing, step one, arrange that information in the format of an income statement. We're going to go ahead and do that. Then we're going to calculate our missing elements and we're going to perform the horizontal analysis. Okay, so sales, cost of goods sold. We know that the next thing coming up is our gross profit. And I can see that I do not have colored cells. So let me add color back into this. All right. And then our administrative expenses. After that, we need to total our operating expenses, and then we need to total our operating income. And then after our income tax expense, we need to total our net income. Now, I could have, again, done a copy paste, but I'm just going to do this the old way. I'm just going to sum things up really quickly. And I'll sum things here. And then I'm going to subtract out total operating expenses from our gross profit. And then our last step is just to sum our operating income expenses, our operating income, and our income tax expense. All right. We'll do the same thing that we did over here. It's just a copy paste. Copy paste and another copy paste. All right. So we've arranged the information in the format of an income statement. We've calculated our missing elements. Now it's time to perform the horizontal analysis. With the horizontal analysis, I first want to look at my change amount, right? And you can see that I've already gotten us started. So the change amount was, I took my current year and I subtracted out my previous year. This tells me that I have, I generated $1.3 million more in sales in this current year. I now want to look at my change percentage, and what do? I actually take my change amount and I divided it by the previous year. So what does this tell me? This tells me that I actually have increased my sales by 28%. Now, given this information, we can do the same thing. We're going to take our current year, subtract out our previous year, and now we're going to take that change amount and we're going to divide it by the previous year's information. And that tells me that I have increased my cost of goods sold by 33%. Remember in our vertical analysis, I said, wow, there's an increase in our cost of goods sold. And it could be good, it could be bad. This particular analysis now really shows you that even though your sales increased by 28%, your cost of goods sold increased more rapidly. So we're going to do the same thing here. And we will look at the change percentage. And again, even though we're selling more, our gross profit is not growing at the same pace. Now, I told you that we were going to look at ways to optimize our time in Excel. So there is a way to optimize the rest of these calculations. You've seen that I blocked off these two, and I'm just going to drag them down. And we can see that while we have no changes in administrative expenses, which is kind of good, we do have our operating expense increased 55%. I'm sorry, our operating income increased 55%, which is really good. So now we want to look at our operating income in relation to our sales. Our sales increased by 28%, but our operating income increased by 55%. And then if we come all the way down to net income, we can see that our net income increased by 73%. So even though we originally had some concerns about our cost of goods sold, maybe in the context of the environment and the economy, maybe this change is not as bad as we thought it was, especially as we see our net income increasing by 73%. Okay, now we're going to go on to a different set of analyses, and these are going to be based on your income statement and your balance sheet. So at the very top, this just says the comparative financial statements of Bettencourt are as follows. And you can see this is the income statement and this is the balance sheet. The market price, though, of Bettencourt common stock was $25 on December 31st, 2016. And it was $30 on December 31st, 2015. So what we're going to do is we're going to calculate the following analyses. And you can see that I've already laid them out. I'm going to open this up so you can see the entire formula. So the entire formula is here. When you are working with these analyses, this is going to be the time that you really want to drag over your financial analyses, your financial ratios formula. This particular one pager not only gives you your liquidity measures, your solvency measures, and your profitability measures, but you're also going to get that formula here in the center and what it's used for. So what I've done is I've taken some of this information and I've loaded it into our spreadsheet so that we can look at it. We're going to walk through each one of these analyses to see how you can very quickly pull it in from a spreadsheet like this. All right. So I'm going to open this back up so that we can go back in. And because you have, oh, wait one moment. Let's drag this off to the side. Because we have our financial ratios sitting off to the side, I'm actually going to close this cell down just a little bit so that we can see everything, right? Now we can see everything. Okay, so blew that up just a tiny bit too much. Okay. A little bit too much. There we go. There we go. Okay. So let's start with our working capital. So working capital is our current assets minus our current liabilities. And really what it's trying to do is we're trying to measure the company's ability to pay our current liabilities. So you can see that the answer is already $750, but where did I get this information from? So I'm going to open up this cell. You can see that I picked up our total current liabilities and I subtracted out our total current assets, and I subtracted out our current liabilities. That's what gives me the $750. And again, if I know all of my current assets and I know what my current liabilities are, then that tells me that I have enough money to pay off the working capital that's how much money I have if I wanted to invest it in something, right? My current ratio is, again, taking those current assets, but this time I'm not subtracting it, I'm dividing it by the current liabilities. That tells me that I have enough current assets to pay my current liabilities 2 times. Do you see that? All right. Now we want to look at our current assets. You can see that with our current assets, it includes cash, temporary investments, accounts receivable, net, inventories, and prepaid expenses. Well, when we're talking about being able to pay current liabilities, my prepaid expenses, that's really hard to pull back from the insurance company that I've paid in advance, or maybe the leasing company that I've paid in advance. So it's really hard to get those prepaid expenses back. Inventory, which is just above it, is also sometimes hard to turn over depending on what type of inventory you sell. So we want to look at the quick ratio. If I had to quickly liquidate as many current assets as possible to pay my liabilities, would I have enough to pay them? So this one, quick ratio, wants to pick up my cash, my temporary investments, and that's where maybe I've got some extra cash on hand. I go to the stock market, I invest in some type of investment that I can very quickly pull my money out of if I need to. and then also my accounts receivable net. And so I know that these are relatively quick and easy. They're what we call liquid. And so this calculation tells me that I have enough quick ratios to cover my liabilities one time. Okay, now accounts receivable turnover. With my accounts receivable turnover, I want to take the my sales, which you see over here, and I want to divide it by the average of my accounts receivable. And so that's where you see that I've picked up these two, right? Because my ending balance of the previous year is my beginning balance of the current year. So these are my averages. Where did I start out the year, which was 325? Where did I end the year? That was 425. And so I'm taking the average of these two, and I'm dividing it into my sales. What does this tell me? This tells me that I turn my accounts receivable over 13 times a year. And we can actually see that expressed in days in the next one, which is my number of days sales are in receivables. So the number of days sales are in receivables, actually you want to take your average accounts receivable, which you see that I've picked up over here, and I'm dividing it by my average daily sales. Well, you can see, let me close this out. You can see that nowhere on here does it tell me what my average daily sale is. So what I'm actually going to do is right here, I'm going to break this down into two different steps. So the first step is that I need to find my average. Now I can do this one of two ways. I can say my 425 plus my 325. I'm going to close my parentheses and then I'm going to divide it by 2. So that gives me 375. Or I can actually ask, one moment. I can actually ask the Excel to average some numbers for me. And I can just type in average, open my parentheses, block off these two, close my parentheses, and that still gives me my 325. There's another step in there, right? And we saw that we needed daily sales. And the easiest way to do daily sales is to take your total sales for the year and you're going to divide it by 365. Now, even if you don't actually have 365 for the year, 365 is normally the amount or the number of days that we use to make this calculation. So now I'm going to press enter. And that tells me that I have 13,698. That's my average daily sales. Now, I'm going to take my average accounts receivable and I'm going to divide it by my average daily sales. And that gives me my 27,375. There you go. This is just a rounding. And if I were to open it up one more, you'd see 27,375. These equal each other. So perfect. What is this telling me though? This tells me that it takes me on average 27 days to collect my accounts receivable. So if someone buys something on account, it takes me approximately 27 days to have the customer pay that back in full. Okay, we're going to do the same thing with the inventory turnover and the number of days in sale for inventory. It's the same principle, right? So this is our cost of goods sold divided by our average inventory. And so here is our cost of goods sold divided by our average inventory. And again, we can do the same thing. We can do a two-step process. Average of my inventories, close that, there you go. So it's my, what did I say? It is the cost of goods sold divided by average inventory. So I'm going to pick up my cost of goods sold over here and I'm going to divide it by my average inventory. And that gives me 5.6. And you notice that I have a negative amount here, right? So I would actually want to remove that negative that it's picking up over here. And I can do that by simply reversing the sign, saying negative as I pick up my cost of goods sold, and then dividing that again by my average inventories. 5.6. Perfect. And what does this tell me? This tells me that I turned my inventory over 5.5 times a year. Well, if we'd said 5.5 times a year, or almost 6 times a year, that would tell me I could almost immediately say, I bet it takes somewhere close to 60 days to for inventory to be rotated out into a sales, or to be converted into a sales. And I'm just guessing that, even if I didn't have this number below that told me, because this tells me I'm turning my inventory over almost 6 times a year. Now, my number of days sales in inventory, we can do the same calculation that we did before. In fact, let me just open it so it's expedient. I'm taking my average cost of goods sold my average inventories, and I am dividing it by my cost of goods sold divided by the 365. You can see it down here. And that does tell me that it takes 64, almost 65 days to convert inventory into sales. That means if I'm making furniture and I have just made a beautiful coffee table, then that coffee table is probably going to sit in my inventory for 65 days until I can find someone who is interested in buying it. Now, let me pause one moment and just talk about the total time it takes to convert inventory into cash. So I just said that this is how much time it's going to take. And let me take the $sign off so that we don't get confused. This is approximately how much time it takes from the moment I finish production on a coffee table until it's sold. If I sell this coffee table on account, then I now have to be concerned with how long that account is going to be outstanding until I can convert it into actual cash. So this really, when we're talking about selling on account, it really is going to take 91, almost 92 days to convert your one coffee table into cash. And so that's why we want to really manage our accounts receivable, and we want to manage our inventory. You're going to have a discussion question that's going to talk about creating more inventory than you actually need. Keep this calculation in mind when you answer that question, and that's actually going to be quite a few weeks in the future. But try to remember some of these calculations because it will come into play later on. Okay, next. So, by the way, all the things that we have looked at so far, these are all liquidity measures. So we also have some solvency measures and profitability measures. So, and by the way, solvency is really looking at how safe is it for your investors, not just equity investors, but the people who allow you to purchase things on account. Okay, so let's go on to our ratio of fixed assets to long-term liabilities. So that formula, let me open this up. That formula is our fixed assets net divided by our long-term liabilities. And so our fixed assets are our property, plant, and equipment at net. So all I've done is taken our property, plant, and equipment, and I've divided it by our long-term liabilities. That is my ratio, 1.73. The question is this a good ratio? And the answer is really a little bit more complex than just a yes or no. It really does depend. It depends on what type of industry you're in, how large of a company are you. even how old your company is. So newer companies, the ratio is a little bit different than companies that are well established. So when we talk about whether this is good or bad, there are quite a few layers that you want to look at before you make that determination of whether it's good or bad. And even changes to this ratio from one year to the next doesn't necessarily mean that it's a good thing or a bad thing. Sometimes you see ratios decrease when a company has, just entered it into a merger, or they've spun off a segment. And so, again, you really have to look at this in a wholesome way. You have to look at it from the perspective of what is the environment, what is the economy, where does this company fit in the industry, even what industry it's in. Okay, ratio of liabilities to stockholders' equity. So we have our total liabilities here, and we've divided it by our total stockholders' equity. Again, that's kind of straightforward, right? And the question is, why are you, what is the purpose of looking at the ratio of liabilities to stockholders' equity? And really, this measures how much of the company is financed by debt and how much of it is financed by equity. So there are pluses and minuses to debt and equity, and every company needs to find that sweet spot, right? If you have too much debt, then economic shocks such as COVID-19, economic shocks such as when the real estate bubble burst in 2008, if you have too much debt, it's very hard to come back and to be a strong company. If you have too much equity, equity actually can sometimes be more expensive than debt, because at least with debt, you get to write off any interest payments. Okay, now moving on to our last two, which are the asset turnover and our return on assets. So with the asset turnover, there's a lot going on here, right? So I wanted to take my sales and I want to divide it by my average total assets, but I don't want to include my long-term assets, because what I'm measuring here is how efficiently a company uses its assets. How efficient are we? So with this particular one, instead of using my average, which you can see in this garble of letters and numbers, you see that I don't have average anywhere. And it's because I want to subtract out my long-term investments. So I've got all of my current assets are here. And I also want to include my property, plant, and equipment. So I have included all of those things, my long-term investments, and my total assets. Or I'm sorry, my total assets minus my long-term investments. And that's what you see here. But then I need to take the average of these two. So I've taken the average by dividing it by 2. And here you can see I have a ratio, an asset turnover of 1.5. Again, it's the same thing as the ratio of liabilities to stockholders' equity. Whether it's good or bad really does depend on a lot. Where they're at in industry, how old they are, what the economy looks like. The final analysis is our return on assets. So the return on assets is our net income plus our interest expense. So we want to add in that interest expense again. And let me go ahead and open this so you can see it. So I've taken my net income and I want to add in my interest expense. Well, actually, I didn't tell you that my other expense up here was the interest expense, but it is. This is my interest expense. And then I want to divide it by my average total assets. And you can see I picked up my average total assets over here. So I'm going to enter, and you can see that my return on assets is 10%. And so, what am I trying to measure here? I'm trying to measure the profitability of a company's assets. Are they really using their assets as well as they should? And again, we can determine if this is a good or bad number depending on the industry they're in. Now, let's think about it. We would not hold we wouldn't hold a service-based company at the same level, or we wouldn't compare a service-based company to a company such as Ford, Toyota, Volvo, because car making or car companies have a lot of assets. Service-based companies don't have as many assets. So we would not be able to compare the two. And that's why when you're looking at whether something is good or bad, you really have to see where they are in their industry and how old they are. And of course, as I've said multiple times, the economy and the environment. All right, this should give you a pretty good overview of what you'll see in your homework. Good luck, and I will see you in the next video.